Welcome back, everybody, to the Investing Show. Today, I have Chief Strategist at BNP Paribas Fortis, Philippe Geisels here, who is the co-author of the book with Cohen Delos, World Economy in 5 Trends. Welcome, Philippe, to the Investing Show.
Thank you, Simon. Thanks for having me.
I loved your book, and I would love to start with one quote, which is about waves. It can be a long wait. This is from the book World Economy in 5 Trends. It can be a long wait for the right big trend wave. Enjoy it, but also remember to jump off in time before it plunges thunderously downwards. Philip, are we on a wave? On which kind of wave are we?
We are on a number of waves, I believe, and the entire book is a little bit about waves. And because I love the beach, I love the beach bar, so I tried to surf once. I'm not very good at it, but I think that investing is really about trying to catch the big waves, and that's also what Warren Buffett does, or all the great investors do. They try to. He calls it the snowball. Is a little bit the same story. And you start with a small ball and it gets bigger and bigger while it runs down the hill. With surfing, it's more or less the same. And you basically try to pick a wave when the surf comes up, and you never know whether it's going to be a big wave or a small wave. But the big waves gives you the opportunity to make some very nice profits along the way. And I think there are a number of very big waves coming, and maybe a very important one is the inflationary wave. I think with COVID starting, I get getting a little bit of sun here. Ola,
The sun likes you a lot, yes.
this is a lot of light. Can I just take it off
Sure,
1 second? 1 moment.
absolutely. I will share another quote from the book, meanwhile, which is full of wonderful quotes. I made so many highlights. One is, we are on the cusp of a different world. 5 defining waves will engulf the global economy. The first is the climate transition, a new trend.
This should be better. Sorry, that was a big wave coming in. The sun.
Yes, I'm quoting from your book. Then there are multi-globalization and an innovation-driven productivity boom, both of which are shifting trends. The last 2 waves, aging and rising debt, are existing trends that will go into overdrive in the coming decades.
Yeah, sorry for the interruption, Simon. So now, when I was talking about one of the big waves, and that's the conclusion of the book in a way, that we were living in a world of structurally higher inflation and structurally higher interest rates. I can talk about commodities later. I think that's also a very big wave. Innovation is also a very big wave, but let me concentrate or focus on the inflation story. So when I sign a book, I very often write, it all comes and goes in waves. It always does. There are very big waves. And because these waves tend to be so big, it's very hard sometimes for somebody to see the shift, but also to see that we have been in a downward wave of inflation since the beginning of the 80s. In 82, until very recently, COVID, inflation was well behaved. Interest rates came down all the time. Now, we believe, and that's the thesis of our book, and that's the logical consequence of all the chapters that we have in the book, is that we are now in an environment where inflation will be structurally higher. And we've seen that the last couple of days because the Fed is also reacting to that, by the way, and where also interest rates will be higher. And living, investing, managing a business in a world where inflation, is between 2 and 4, with potential overshoot to the upside, is totally different what we're used to. But a lot of people, I was 12 years old in 82, so I've never seen an environment of higher inflation. And therefore, my thesis is we have to go back to the 60s and the 70s, that were the previous big inflationary wave, which drove interest rates higher. And that is a totally different environment to invest in, which is, by the way, was, by the way, a very good environment for commodities. And I believe we will have a very good environment for commodities going forward. Another big wave is the innovation wave. And the chapter in innovation in the book, there are 5 chapters. The 4 others are inflationary. But innovation has the potential to drive inflation lower. And we don't know how big the AI cycle is going to be. We don't know how big the quantum computing wave is going to be. But there are very, very interesting things happening. And that's the reason why we wrote the book in the first place, because we thought that the world was profoundly changing. There are some very big waves coming up. And I think, and I'm absolutely convinced, this is an environment, this is a world where fortunes can be made and fortunes can be lost. And therefore, we have to study and we have to try to be as prepared as we can ever be.
The 5 trends in your book are productivity and innovation, climate transition, multi-globalization, debt, and aging. And 2 waves that you just described. One is guys expect interest rate to be more around 2 to 4%, maybe even over 4% as the norm over the next decade. And the other one is there will be a commodity super cycle. Can you describe the commodity super cycle?
Yeah, that's also probably new for a lot of people because we have been in an environment where commodity prices have been fairly low and not too volatile. And the last big cycle was in the 60s and especially in the 70s with the oil shock. I believe that there are always reasons for this to happen. There is a lot of demand. There is let me make maybe the abstraction between soft commodities and hard commodities. The soft commodities, the cocoa and the grains and the soybeans and so on, and the coffee especially, well, if you take them all together, well, they're at all-time highs almost. And I think that's related to the climate change for a certain extent. If you look at cocoa, for example, it's 51% from the Ivory Coast, so it's very concentrated. So if something goes wrong with the harvest or diseases or something, well, I think these things will go way higher. Now, they're very difficult to predict because it depends on harvest, and you can have a positive harvest or a negative harvest. So it depends a little bit from year to year. But climate change will drive the soft commodities way higher. That's one thing. But the point I would like to focus on is more on the metals, the hard commodities, especially the metal complex, the precious metals, but also the copper and the nickel and the cobalt and the zinc and what have you, because there is a massive demand for all these battery metals, as we call them, because of the electrical revolution. That's one thing. But unlike the 60s and the 70s, or unlike especially the big the previous commodity cycle that we had somewhere in the beginning of the 2000s, which was demand driven because all of a sudden China started to ask a lot of commodities to build their industrial complex. That was a demand story. Today, we also have a demand story from the battery metals. But the reason why I believe, and that's the most important reason why we're really in a super cycle and why we write in the book that potentially copper prices could easily double at a certain moment in time, is also from the supply side. We all know that just to satisfy more or less all the demand for the battery metals and for copper coming from the electrical revolution and the EV revolution and the electrification and what have you, you need about 200 new copper mines. And we just don't have them. And even if you were to decide today, okay, let's start building things, well, it takes you 10 to 11 years at least to open a new mine before you have the first grams or kilograms of copper out of the ground. So you will have shortages of this for at least 5 to 10 years. So I think this will be a massive opportunity. And as a bank, we're very much behind this electrical revolution. We want to have a better world for our kids and for our grandchildren and so on. But if we do not do it in a sensible way, we run the risk that we'll have very big problems in the commodity space and that these prices will go up, creating a lot of inflation. Now, as an investor, well, this is a once in a lifetime opportunity. And now it's all masked a little bit, camouflaged a little bit, because interest rates go up, the dollar goes up. So that's typically something that commodities do not like very much. And the Chinese economy is weak. But that's a little bit the story of 2024. I think going forward, I see this massive bull market materializing. And I think we're still very much in the very first inning of that. There is a lot to come afterwards.
I could never invest in a copper mining company because I am not an expert. I don't know how to do the valuation of a copper mining company. I don't know how to assess the risks. What is your model for evaluating, assessing risk of, let's say, copper involved companies?
Well, there you have a very good point, Simon, and it's very hard because it's not only looking at the balance sheet and at the results and at the income statements, but it's also a lot to do with environmental things. You can have a strike, you can have an accident. So investing in one copper mine, especially also when it's a mid-sized player or even a junior miner or something, is always extremely difficult and dangerous because it's binary. It's 0 or 1. It goes exceptionally well, and you double your money or you quadruple your money, or it goes bankrupt. So that happens. So if you want to invest in this, and that's what we propose, and we have clients who look at individual names and they're really specialized, but they know the risks also of these things. But if you want to invest in this, I always think it's better to do it through an ETF or through a fund. And then also a fund which is a little bit mixed. There are trackers, for example, on the New York Stock Exchange, where you buy a basket of these names. And then, of course, when something goes wrong with one of them, well, it's not that bad. So then you can invest in the team. And the good news of these things is you buy the big players, but in a lot of these funds, you have also the mid-sized players and some of the smaller players as well. And this gives you a very good diversification because it's the small players, the juniors and the mid-sized players that are even more interesting because they are valued. If you look at, for example, the Toronto Venture Exchange, these were all stocks that quoted $3, $4, $5 and that now quote 10 and 20 cents. So there is, as a group, a massive opportunity. But what needs to happen is that first, the bigger guys go up, their stock prices go up, and then they can start to use their equity as a bargaining chip or as a currency to start buying smaller players. And then it moves through the food chain, through the ecosystem, but that's not happened yet. So the bigger names have moved. They moved at the first move this year, but it all stalled, like I said, because the dollar went up and interest rates went up and the Chinese economy is so weak. But I think this wave will continue, this upward wave, into 2025 and way beyond. And there will be some very interesting opportunities there. And I like that you mentioned copper because that's my favorite in the space. Because problem is as well, I believe in this electrical revolution. I think that batteries will be hot. They will grow very fast. But the point is, nobody knows what the battery of the future will look like. So you don't know how much nickel and how much cobalt you're going to have. Maybe cobalt will be replaced by nickel to a certain extent. It's even possible that lithium will be replaced by sodium. So as nobody knows the battery of the future, it's always very dangerous to make a big choice between the different batteries or the different metals, I would say. But the point is, if you want to transport energy from point A to B, you need copper. So therefore, I'm very convinced about copper. I also like, if you ask me to pick one metal for next year, I would pick silver, which is a little bit between gold and copper because it's half industrial, it's half a precious metal. It's very cheap because it's only $30 and we used to have 50 somewhere in the 2000s. You even had this 50 somewhere in the 70s. So it's way below its all-time high, even though gold is fairly close to it. But the good news is also in batteries, when you go to solid-state batteries, and that looks to be one of the trends of the future, you need 200 grams of silver in each battery. So demand will increase there as well. So silver is also a way to play the battery revolution.
We have a public portfolio here on the Investing Show because we want to help people. I'm a learning investor, a beginner investor, 13 years in the game. And so I'm learning in public. I'm asking people like you, how many years are you in the game of investing now?
Longer than I care to remember, but it should be somewhere 30, 35 or so.
In the 35-ish, yes. And so that's why I ask experts like you for criticizing our portfolio. So I will walk you through our public portfolio and we can apply the assumptions from your book. So let's apply a 4% and even higher interest rates. Let's say commodity cycle is coming and all your 5 forces are at play, which are the weaknesses of this portfolio? What would you change in this portfolio?
Well, it's not my job to make predictions on individual names, but I think when you go to a portfolio, you have to have a nice equilibrium because you can take very big bets on one thing. I think diversification is the only free lunch. So you should, even if you believe in innovation, even if you believe in a way in everything that has to do with the commodity cycle and so on, you should make sure that things, you are diversified. Now, what's the problem? Not necessarily with your portfolio, but with all the portfolios at the moment worldwide. If you look at the last couple of days, you had yesterday, you had Jerome Powell of the Fed talking. He was fairly hawkish. He probably they're not going to cut interest rate as much as they said they were before. So that indeed created some volatility on the markets, and that was a little bit scary in a way because what you do not like in any portfolio, but that will be in a way something that's going to happen way more in the future. You want your positions not too much correlated. You do not want days that everything that you have in your portfolio goes down. And what happened the last couple of days is, okay, we're not going to cut interest rates as much. So long-term interest rates went up. And that immediately, of course, the value of your bonds goes down. But that created also a negative feedback loop towards equities. So you get in the situation that bonds and equities go down together and go up together. And that's something that's very typical for an inflationary environment. In an environment where inflation is low or not an issue, that's not happening because then when stocks correct, typically your bonds go up and you make up for them. So if you believe that, and I'm absolutely convinced that that's going to be the case in the next months and years to come, you should probably look for alternatives that are not so much correlated. And then commodities could help. Now, to be fair and honest, I'm a big bull on gold, as you know, as well. I have a target of 4,000 of gold in the portfolio, but also last couple of days, gold has been going down as well because gold does not like higher interest rates and a higher dollar as well. So even gold is not always helping you a lot. So what I would like to put in each and every portfolio, but I must admit, we're managing money at a fairly big bank. So that's also an idea. We're thinking about it, but it's not very well developed yet. But I would put things like CTAs, hedge funds, trend following things that could potentially go up if the market corrects. And then you get to this negative correlation. So that's a little bit the story. Now, another important point is, and that's basically the main question we have been thinking about 2023 and 2024, is how much technology do you put in? Because as a European investor, we're based in Brussels, but BNP Paribas is a big European bank. So basically, you have a focus on Europe. We've already invested quite a bit in the United States because the United States has outperformed all the other markets 14 of the last 15 years. That's not nothing. If you had bought anything else except the US, and then you can even say the US technology, because it's US technology that's driven that market, you were in big trouble. So the entire asset allocation decision of whatever portfolio that you have boils down to the question how much Nvidia and how much Apple and how much Microsoft you're going to hold and how much of all the rest you're going to hold. And being extreme is dangerous because if you do not have the big ones, the Magnificent Seven, well, you had a performance of 2 or 3%, while the S&P went up 20%. So there's a very hard sell to clients. Of course, if you miss all the opportunities of the parts that are in the market, like commodities, like energy, like many other things, you're missing out as well. So that's maybe the most difficult thing today, to find the right equilibrium between the tech and all the rest.
2024 was dominated by the Mach 7. Will 2025 still be a wave of the Magnificent Seven? Or is that wave at its peak?
Well, we can say this is already has been a very big wave, one of the biggest that I've ever seen. Like I said, if you outperform 14 of the last 15 years, well, it's a wave that's already quite old. Now, there's nothing that says that it should be over in 2025. I think that the risks have increased. But then again, and then that's what we also write in the book, um, nobody knows how big this AI thing is going to be because this is something completely new. And this fairly easy to say, okay, this looks like internet at the end of the 2000s, end of the 90s, beginning of the 2000s, because take AI, take NVIDIA. NVIDIA makes these chips, and that's the heart of AI. Everybody needs them to develop their AI business. You could say that's very comparable to a Cisco, for example. Cisco at the end of the 90s, they had the heart of internet. They made routers, they made switches. They traded back then 40 times revenues, not earnings, but 40 times revenues. And that's the same with NVIDIA. And then, of course, the bubble popped, it all came down, and it was Cisco was dead money for 10, 15 years. Microsoft, by the way, has been dead money for a very long time before they had the big run that we've seen the last couple of years. So there is a point of comparison. Now, a story that's in the book, and it's a story by my co-author Koen, and he's been to India 2 years ago to study and to travel and to try to understand the country. And he came back with this story, says, okay, the chessboard, the game of chess, has been invented in India. And the inventor of the chessboard, he went to the Maharaja or the Sultan, or I will call him Emperor. That's maybe the easiest one. Goes to the Emperor and he says, look, Emperor, I've invented a new game, and it has pawns, and it has knights, and it has horses, and towers, and bishops, and he explains everything to him. And the Emperor is really excited. He says, that's fantastic. That's unbelievable what you have given to the Indian people. What do you want as a reward? And the inventor says, Emperor, I'm a humble man. I just want some food for my family. I just need some rice. And then the question is, how much rice do you need? Well, he says, a chessboard is 8 on 8, so it's 64 squares. He says, put 1 grain of rice on the first square, 2 on the second, 4 on the third, 8 on the fourth, and so on, and fill the board like this. Now, you see what's going to happen when you're at a 30-second square, and that's half the board. You're already at 5 billion grains of rice. Now, that's a very interesting square because that's the last one where 2 ideas can coexist together, basically. And the emperor is still emperor, and the inventor still has his head. If you go to the second part of the board, you get into the Matrix, or you get to an Alice in Wonderland, and then, of course, or the emperor has to give his entire kingdom or everything that he has to the inventor, or he has to chop off his head. Now, the story tells us, unfortunately, the poor man's head has been chopped off. But the point I want to make here, people are very difficult at understanding, very bad at understanding exponential growth. So if you look at the earnings, back to NVIDIA, if you look at the earnings and the revenues of NVIDIA, it doubles basically each and every year. So the price sales is 40. But if you double, you go to 20. You double once again, you go to 10. And you double once again, you go to 5. And then you're at a very reasonable valuation in 3 years' time. Now, we all know you cannot double indefinitely, because if you would double for 10 years, NVIDIA would be bigger than the United States. And if you would double for 15 years, NVIDIA would be bigger than the entire world, or even faster than that. But the point is, if you can do this for 3 years, well, you get all of a sudden to a more reasonable valuation. So I think when you look at AI, and now all the quantum stocks are going up like hell, and that's maybe even more dangerous because, okay, AI is something where we already have applications. Quantum is somewhere in the future, maybe in the near future, but still there is some work to be done. Some hurdles have to be overcome. So you do not have something that's ready at the moment. So, but the stocks go up incredibly fast. So,
what are some quantum stocks? We never discussed quantum stocks here.
Well, you have three waves. One of them you have QBT. This for because it's not bits, but it's qubits. So there are four or five of them quoted. But they're all basically very small. So the point is, yeah, the problem is if everybody wants in these quantum stocks, there are only 5, 6 names. You can easily find them on the social media or on internet. But these things have gone up 30% a day for many days in a row now. So they have doubled, quadrupled, even more. It's not without risk either, because we have just written a little paper for clients saying, okay, if you want to play this quantum story, it's maybe better to go with the big names. And then again, you come very quickly with the big names because Google has
Google,
developed a new
Amazon.
quantum chip and the stock has gone up. Okay, it's not gone up threefold, which would have been difficult from the valuation that they have already or the market cap that they have. And IBM, for example, they have a lot of patents in quantum. And I believe at the end of the day, these guys, because quantum and AI is very much interlinked, because quantum computing will provide the computer power that AI needs to do its searches, but AI will be better in taking the bugs out of the quantum as well. So companies that are very good at AI logically have a big advantage in quantum as well. But I think these guys have deep pockets. They have all market caps of 3,000 billion and more. If there is a smaller player that they really like and they say, okay, we like that technology, it does not matter how much they pay for them almost because they can buy it with their own shares. And I think therefore the big guys will be bigger and stronger. And that's the reason why it's so dangerous to leave them all together out of a portfolio, because they have the money, they have the engineers, they have the knowledge, they know the ecosystem. So it's a fair assumption, I think, to think that these guys will dominate a lot of the fields in the future. It was very interesting, and I'm not a technology specialist because I have people in my team who know this way better than I do. But the point is also that an Amazon, you would say, that's a bookseller, and a Tesla, okay, they make cars, and Google, that are search engines, and Microsoft, that's software. But the point is, they all start to come in each other's fields. Amazon is also developing chips. Microsoft is also going in AI. So these companies start to look more and more similar. And that's a very interesting way of looking at it, I think.
I'm glad to hear that in our public portfolio, we have Google and Amazon from the Mag 7 with similar reasoning that they have the distribution, they have the modes, they have the current user install base. So if somebody can win at AI, for them it's easier. Of course, there would be also Microsoft, but for valuation reasons, we are out of that. What are you currently reading that inspires you?
Well, you see her behind me and drives my wife crazy. Now, I must admit that the weights, that's not me. That's my son who trains here from time to time. But the books are mine, so and our entire house looks a bit like this. So I read quite a bit. Now, to mention a couple of books, which because we can start to talk literature as well, but I think you're mostly interested in investment ideas. Our book, by the way, the New World Economy, is a book about books. So we mention about 100 to 150 other books that we think that are interesting. And one that we've been talking about a lot in the press, and also especially since the election of Donald Trump, is The Fourth Turning is Here by Neil Howe. And that's an update of a book that was already written about 30 years ago, The Fourth Turning by Neil Howe and also Mr. Strauss, who unfortunately passed away. So it's an update, but it describes very well the current situation that we're in. And I always say our book at the end of the day is an optimistic book, because we see a lot of challenges. We say, okay, we have never seen so much challenges, but that makes that the opportunities are even better. So that's the positive message. If we work and we study, we can do well. Like I said, this is an environment where fortunes can be lost and made. So let's try to be on the good side of this story. Now, The Fourth Turning is a book I always say, do not read that at the swimming pool during your holidays because it will depress you. Do not read it under the Christmas tree. I always say Halloween is a very good period, but Halloween is a little bit behind us at the moment already. But it's a book, if you read this, it's also about 400 pages or so, and you look at the world, well, then you say, yeah, I'm seeing this. I'm absolutely seeing this. I see, unfortunately, conflicts between countries. I see wars in the Middle East. I see wars in Ukraine and potentially in other places in the world. I see politics being extremely difficult everywhere. I see extreme left wing and extreme right wing parties win. I see the center getting smaller and smaller. So that's extremely difficult to navigate in a world like that. And I have to still have to walk around during the Christmas time to ask all my bottles, because I've won quite a bit of weight of bets with people saying that Donald Trump would win and he would also take the Senate and the House, because that's exactly what you expect in a fourth turning. People are generally so unhappy that all the sitting presidents, first ministers, governments, parties, whoever is in power, left, right, bottom, up, down, wherever, they lose. So that's something that you expect. And this volatility in a fourth turning, because we're absolutely in a fourth turning at this moment, will create a lot of volatility in markets, which will also bring us opportunity. A second book, and that's what I was touching upon, and I can recommend it to also to read. I always said I wanted our book to be a nice mix between Erin Morningstar, and she's a fiction writer. She wrote the Night Circus and The Starless Sea, which are both fantastic books. So I love the way she writes. But then for content, I'm a big fan of everything that Michael Covell does in his podcast, but also in his books. He has written many books, and yeah, maybe the best known is trend following, and that was what I was touching upon. That's where we started our conversation, that you want to see these big waves. You never know how long a wave is going to be, but you try to surf it as long as you can. And like I said, in a world where bonds and equities are very often moving in the same direction, you have to find alternatives, and trend following could be it. So it is also a very big book, but I think that trend following, it has changed my way over the years, that I look at the world, I look at markets, I look at things even way beyond investing, how one could live his life, continue do things that you like and that you're good at, try to cut off things that you don't like and you're not good at. So that's also something that you can do in real life, which is not investing. So these are two books that I would really highly recommend.
Thank you. I have also noted the podcast by Michael Covell. And so, with these 5 things, big shifts, changes, what is it that will not change, that will stay the same?
Yeah, that's once again, you ask. I've done a lot of podcasts this year, but you ask very, very good questions. Thank you for that. Now, I think what's not going to change is human behavior to a certain extent, because I've seen this industry change. When I started out, there was no internet. So I think a lot goes faster these days. There's no longer, or not a lot of floor trading. It's all computers. You have the algos. So a lot of things have changed in terms of technology. The market has changed probably. Like I said, it's faster probably than it was before. But there is still the human behavior. So we're still the same people. Okay, we can say to the computers, you take the decisions, then we're in another world. But as long as people take the decisions, I think we're still very much going to make all these mistakes and all the biases that we have. And that's good, because at the end of the day, if you're a little bit stable, you're not panicking too fast, you can arbitrage a little bit the extreme feelings of greed and fear that basically dominate the market. And my thinking also there has changed a little bit, because I always thought it's greed and fear that drive the markets, and that to a certain extent it is, because people become fearful. They sell things at ridiculously low prices, and when they get greedy, they start to buy stuff at incredibly high prices, and very often this leads to disasters on both sides. But I start to believe, and I'm thinking about a new book, and I'm already writing some stuff about it, just about trading. And I was thinking about this greed and fear thing, but maybe it's even more envy. I think there is a lot of envy in the market. Your neighbor or your brother-in-law or your barber or a friend or a colleague, they're all making money in Bitcoin or what have you. And then you say, I cannot stand it anymore because everybody is making money. I'm going to do this as well. And that's not necessarily greed, it's envy. It's the fact that somebody else is making money. It's what the younger people also have, and I'm a big fan of the younger people, because in our book, the Gen Zs and so on, and the millennials, I talk about the young wizards that are going to change the world. And when I go 2 floors down the stairs here, I have my girl is 19 and my son is 21. So basically, that are the young wizards you talk about, but their greatest fear very often in investing, but also in life, is FOMO, fear of missing out, envy that other people are making money, other people have a party where you're not participating, and I think that's not going to change. So as long as markets are driven by people, we're still in the savannah of Africa. So many hundreds of thousands of years ago, there is still the herd. It's very often a good idea to go with the herd, because if there is a lion or a crocodile or something you've not seen, and the herd flies or moves away, it's better to go with them. In investing, it's not always the case. So I
Look
think
forward
there
to your book
lies
about
the
envy.
biggest and the biggest danger, but maybe also a biggest opportunity.
It is definitely hard, and we get these questions all the time. Simon, we are out of Nvidia because you say it's overvalued, and it's not. Um, it does not yet show long-term moat and defensibility and predictability. But everybody's making money on Nvidia, and we are on the sidelines. So envy is in the room. It's hard as a young investor to cope with that. We try to say, okay, follow your process, have your valuation method, whatever it is, DCF or exit valuation, and stick to your process. Try not to look at the price every day. Maybe you check it once a week. Maybe you write it down so you have a journal so that you have a discussion with yourself more than with others. What are some practices that you can give young investors like us to be less in envy driven?
Well, I think you've already mentioned quite a bit of things. And while we were talking about books, we talked about Michael Covell. I think you would certainly listen to the podcast and read his books. You also have The Market Wizards by Jack Schwager, who's already a little bit older. The New Market Wizards, The Market Wizards, Unknown Market Wizards, Hedge Fund Market Wizards. So there are a number of books. And then indeed you look at these practices, and you've already mentioned 2 important ones, I believe. One of them is having a process and trying to stick to the process. So because it's very easy to get influenced, and like I said, I've been doing this for 35 years. I continue also to make these same mistakes. If you have one big rule in investing, is let your profits run and cut your losses short. That's always a good idea. It's easier to do on a technical trend following system than on a fundamental system, because in a fundamental system will say I bought it because I thought it was cheap. It went down, it's even cheaper, so I love it even more. So that's one of the pitfalls that you have with a purely fundamental system. Not saying that this is wrong, but that's more of a problem. But you need this process, and we've been there many times before. We went with some friends in Europe to France to have some wine and to taste some wine. And you have the weekend and on the Friday, and you have 2 positions. One you have very nice profit on, another you are at a loss. What do? You know what you should do. You should keep your winner and cut your loser. But what do? You take your winner off the table because it feels great. You pocket some money for the weekend, and you think, the loser will come back. Of Of course, what happens? The winner keeps going up and the loser keeps going down. You know that because you tell that each and every day to your clients until you have to do that yourself. So that's so what I've done a little bit to already get off the problem of getting being influenced by the market, getting nervous and so on, is to make the decisions when the markets are closed. So you take your decisions after 10 o'clock my time, because then Wall Street is closed in our time,
Mm.
and
Mm-hmm.
then the price is not moving, because the
Mm-hmm.
fact that the price moves sometimes lets you do things that
Mm-hmm.
you do not want to do. Another good thing I think you have mentioned, and that's something that I can also highly recommend to everybody: have a journal. Write down what your thinking was, why you've done something. When you're a fundamental investor, what is your reasoning? Is it valuation? Is it, like you said, is it a mode that you think that they have? And that allows you to once again start to reevaluate a position again, because you have to know what, because you have a number of biases. You have confirmation bias. If you want to buy, you're going to find reasons to buy, and you block out all the reasons not to buy. You have recency bias, means that only the last data you're going to look at, and we forget all the rest. In our book, we try to look back at the 60s and the 70s, so that's not recency. We just try to look further down, but you're going to trade on your last mistake or something like that. So these are all things, and I'm very happy that you asked this question, because like I said, one of our new book is going to be about trading, but exactly these
Mm-hmm.
things, not okay technical analysis stuff, how do you draw a trend line and so on, but also more the mental side of things,
Mm-hmm.
because you need, and that's the big advantage that these trend followers, or the, because a lot of people try it, but the people who are successful at it, they have a system. They have a system. If I break my 200-day moving average for 3 days in a row, I just say something, well, I'm out, and I
Mm-hmm.
do not double guess it. So you have to find a system that works for you, because everybody needs a new thing. But there are things that we can do. But we could talk for hours about this, because it's a very interesting topic.
Thank you. And everyone, this was a jewel. We can all implement this. Think about when you take these decisions and when is a good time zone. For Philip and me, it's 10 p.m. because then for us, the markets are closed. What is your time slot, time zone where you are more rational and less driven by emotions so that you can stick to your plan? And what is the system that you have? I can share an experiment that I have started doing with myself and with my kids. So instead of looking so much at charts, I have printed my core holdings, and I have put them on the wall. And then with my children who are 6 and 9 and 2, and so I want them to be aware of these things and learn these things in a playful way. Every year that we are holding it, they put a sticky dot in here. Every December we do it. So this time of the year we will put another sticky dot of something that we are holding, and we are proud of ourselves that we are holding it one more year. And so, because my weakness, selling too early, selling the winners. And so I'm trying with this experiment to involve also the family into this and to think about long-term mindset. Right?
That's a very interesting point, because if you ask me, I've made all the mistakes in the book. I started to buy, and that's, you're too young for that. But I first company I ever bought was a European Italian company, an Italian
Olivetti.
computer, Olivetti. Yeah, yeah, I know it. And the reasoning was indeed, back then there was no internet, so you had the newspapers, and then you would look up the 52-week highs and the 52-week lows in the newspapers, and then you would go to look for the cheapest one, because the idea was
Mm-hmm.
something that's gone down a lot, well, it will come back. But of course, it does not come back. And then you start to say, I should not buy the lowest ones, but I should buy the low valuations. I want the low PEs. But then you
Mm-hmm.
buy only cyclicals, steel companies, and so on. You never buy technology companies.
Mm-hmm.
So you move gradually, and you still make mistakes, but okay, when experience is an accumulation of mistakes, I have a lot of experience, so I've made a lot of mistakes. But like you said, if I could turn back some of the decisions that I've made, which cost the most money, was not being in losers, because okay, they can go from 100 to 0, but not riding out winners enough, because I held things that went up 20-fold, 50-fold, 100-fold, and then you sell at the double or the triple, and you feel like a genius for a while until it keeps moving, of course. And then you say after a number of years, maybe I should have held on to this stock or to that stock. So, and that's more, because if you lose on a position, you can lose your 100%. But if it goes up 7-fold, well, you have missed way more. And if you have a couple of these names, then you can make up for a lot of losers. But you need these big winners. So that's indeed a very, very important point.
Because it is very hard to look at that green 400% and you see it and you go, I can't keep holding this. It cannot do another 200%, right? And so I prefer to look at the wall instead of at my spreadsheet and to think about fundamentals. This is so helpful, Philip. Thank you so much. Is there anything that I forgot to ask you?
No, I think we've talked about quite a lot of things. We talked about trading, we talked about life, we've talked about books. Well, I already said that I think that 2025 will be a very volatile year, because the geopolitics will be very volatile. Nobody, let's be honest, knows very well where the world economy is going at the moment. Central banks do not know either, so all their behavior on interest rates will also be extremely volatile. So I think that I think that everybody should take a good rest over the Christmas periods, get fresh, get a little bit relaxed, do some fun stuff with the family, because I would say buckle up, because I think that 2025 will be a complicated year, but okay, a lot of volatility also means a lot of opportunity. But thank you very much for all your very interesting questions. Like I say, I do this on a fairly regular basis, but you ask some questions that I think are very useful, and I've tried to answer them as good as I can. But like I say, I do this for 35 years, and maybe it's good to tell this to everybody. I make mistakes each and every day. So the day that we do not do that anymore, I think we don't grow anymore. You can only learn from mistakes and not try to make the same mistake, not even twice, but not too often, because twice is already also okay. But this is a tough game, but this is one of the most exciting games in the world, and I still love it each and every day.
The book, everybody, is World Economy in 5 Trends. You are very active on LinkedIn and X. Where do you prefer people to go?
Well, I post some stuff on X, but most of all, I'm on LinkedIn. So I have a book challenge. So I put every week a book up that I think is interesting on trading, on investing, but also on totally different stuff. I publish some quotes. I publish most of my podcasts on LinkedIn. So I think that LinkedIn is the best place to go.
Thank you, Philip, for being on the show and for sharing your wisdom with us and your experience. Keep rolling.
Thank you very much, Simon. Thanks for having me.
Avoid trying to do thousands of things that doesn't work. We have 274 templates for your business success. Reach your ambitious goals with one-on-one sprint coach. We double your revenue in 90 days.
What if, well, even when you are on vacation, discover how 1,600 business